Ladies and gentlemen, we have some very good headlines today coming out of China that China is actually going to exempt more products from their 125% tariff rate on U.S. imports. Now, here's the deal. Trump is going to give a speech at 5 p.m. Eastern Standard Time today, so about an hour from now. And it's anyone's best guess on what's going to be said. If there is positive developments on China, the stock market is going to go crazy from here. If we don't get those positive developments, we have a bigger issue. Now, I will give you all of the news you need to know. There is earnings that you need to know about. There's a lot of economic data today, even more data coming out tomorrow. GDP, the first report at least for Q1, PCE data that comes out tomorrow, a bunch of other things. We'll get into all of that throughout this video, but look at the S&P. The S&P, at the time of recording this video, broke above its 300-day moving average. If this speech goes well with Trump in about an hour, you're going to see markets explode higher. That's the bottom line. Now, here in this video, I will also share with you this clip from CNBC. From JP Morgan's Gabriela Santos. This says time is running out to see a lessening of tariffs on China. It's being reported today that port data out of China is showing a 40 to 60% reduction of outbound goods. That is not good. It's also being reported today that retailers have about 5 weeks worth of inventory. After that period, the Port of LA is expecting to see up to a 50% reduction of goods or traffic at the port. This is going to mean shortages. This is going to mean an inflation problem again. This is going to mean a severe recession. Time is literally running out as we speak to pause the tariffs on China. You almost have to see a pause in the tariffs on China. Almost. I mean, unless Trump wants to full send this economy into a recession, you are going to see a pause on China tariffs. And it looks like things are headed in that direction. I am positioned for that. I am expecting that. I don't know if we're going to get that from the speech today with Donald Trump. I'm optimistic that we will, though. So it's going to get crazy here. I have all the details, everything you need to know here in this video. Hit that like button and subscribe to the channel if you have not done so already. Let's go ahead and get started with the big headline coming out today from China. Now, here on the day today, the big news, really, if you want to point to one thing, is that China has waived the 125% tariff on ethane imports from the United States imposed earlier this month, as per Reuters. There was also quite a bit of drama today with Amazon. Caroline Levitt suggested that Amazon's theoretical listing of import charges, or charges the consumer would have to pay via tariffs, listing that on the website was a hostile move, which how is that a hostile move? If you guys caused prices to go up, like, that should be listed for the consumer, right? You shouldn't try to hide that. Okay. Topic for another time. But Amazon basically came out today and said, we weren't planning on doing that. But some divisions of our business were, like the team that runs the ultra low cost Amazon Whole store. They have considered listing import charges on certain products. This was never a consideration for the main Amazon site, and nothing has been implemented on any Amazon properties. So White House is kind of bashing on Amazon. Amazon saying, whoa, we're not doing that. So a little bit of weird drama with Amazon and the White House. UPS CFO on international shipments says, we expect China to the U.S. to decline a little less than 25%, but that's going to be offset by material improvements in China to the rest of the world and the rest of the world to the U.S. And according to people close to the White House, the deal with Japan is still not ready to be announced. It could be a week away or so. Negotiations center on Japan buying from the Alaska LNG pipeline. India is there, my sources say, according to a Fox reporter. So an India deal could be announced as soon as today. Bloomberg says the S&P 500 still has plenty of room to fall if a recession is inevitable. U.S. April Consumer Confidence Index fell to 86.0. The consensus was 87.5. This is the worst number since 2020. So, yeah, people don't feel good at all. But what's way more concerning than that is the JOLTS job openings. Okay, you were expecting 7.48 million or so. Call it 7.5 million job openings. You came in at 7.192 million job openings. Okay, so you came in 300,000 less than expected. That's a pretty damn big fall. Okay, it definitely could have been, worse, but that's a big fall. Okay, things are definitely not trending in the right direction for the labor market. Things are getting weaker and weaker. Okay, you're now back down to pretty much the same level you were at in September of 2024. Again, September 18th, 2024 is when the Fed cut rates 50 basis points. They were worried about partially this. So take it for what you will. If we don't have an inflation problem in the next couple of months, this is a good reason for the Fed to start cutting rates again. But, I mean, is the damage starting to be done to the labor market? That is going to take some time to see. And unfortunately, the longer it takes to get deals done, the more damage is going to be done. And, I mean, hopefully we get good news today in after hours from Trump on a potential trade deal with at least India, hopefully some other countries. What I'm really looking forward to is the pause on China tariffs. I think that is coming. I think you have to do that in order to negotiate, and it's really only just a matter of time. You also did have the goods trade balance, advanced data for March that came in at negative $162 billion. The estimate was negative $146 billion. So that really came in worse than expected as companies over-ordered in anticipation of the tariffs, right? That's what's going on. Companies, Walmart, Dollar General, a lot of retailers especially, they're over-ordering right now, building inventory in case the tariffs do go into effect, okay? That's why you got this blowout of the goods trades balance. And again, retail inventories excluding autos was expected to fall and be negative 0.2%. It was positive 0.4%. So again, that's just kind of a testament to people or companies boosting inventories. Wholesale inventories month over month as well came in at 0.5%, pretty much meeting the estimates. Now, what this does though, when companies are ordering like this, is it lowers the GDP numbers. So as of today, the latest GDP estimate for Q1 is negative 2.7%. If you exclude gold imports, which is the alternative model forecast, you're negative 1.5% for Q1 GDP. Here's why this is kind of crazy. Because tomorrow we get the first read of the GDP report for Q1. GDP growth rate, quarter over quarter, advanced data for Q1. You're still expecting 0.4%. Last quarter was 2.4%. I don't see how it's going to be positive tomorrow, just based on the trades data that we've seen, right? Or trade data that we've seen. It's not going to be positive. I would be very surprised if it's positive. Now, I think most people expect a negative number tomorrow. So if it is positive, then that's going to be a surprise, I believe, even to come in line with estimates of a measly 0.4%, may be seen as good news that we're not already in a recession. But if we get a negative number tomorrow, it's probably priced in. Just depends how negative is it, right? If it's really negative, if it's like negative 2%, yeah, that's probably not going to be seen as positive. If it's negative like a 0.5%, that may be seen as maybe a little bit better than what it could have been. It's hard to know. We will get these numbers coming out tomorrow morning at 8:30 in the morning. At 8:15 in the morning tomorrow, you will get the ADP employment change. This is the private payrolls. You're expecting around 110,000 job ads. Last month was 155,000 job ads. So this is the basically the non-government jobs report. it doesn't tend to have a super high correlation to the government jobs number, like non-farm payrolls. That comes out on Friday, so keep that in mind. Still huge catalyst coming soon. You do have real consumer spending quarter over quarter advanced data for Q1. You're expecting that to come in at 2.2% positive. Any further drop there would definitely be seen as a negative. But you do have Chicago PMIs that will be coming out tomorrow as well, expecting those to fall. Core PCE month over month, expecting that at 0.1%. Versus 0.4% last month. So expecting inflation's really plummeting at this point. Personal income month over month expected at 0.4% versus 0.8% last month. And personal spending month over month is expected to be strong at 0.6% from 0.4% last month. So you're actually expecting some pretty good data tomorrow morning besides that GDP report. The GDP report is going to look pretty ugly in my opinion. You will get pending home sales month over month and year over year as well. I believe you have some bond auctions, but that's going to be it for your day tomorrow. But on top of all of the economic data, you are going to have a bunch of earnings coming tomorrow. You're going to have earnings even today and after hours with Visa, Starbucks, Snapchat, First Solar, PPG, and Booking Holdings. Tomorrow morning, you get Humana, Caterpillar, Western Digital, Generac, GeneX, ADP, and GE Healthcare. But it's in after hours when you have all of the bigger names. You have Microsoft, Meta, Robinhood, Qualcomm, Albemarle, and a couple of others. So obviously from a market cap perspective, you got like $4 trillion, more than that, reporting earnings in market cap value tomorrow and after hours. So like, you're going to move the markets based on that. But it's Amazon and Apple Thursday that are really the companies that Wall Street cares about. These are the ones that are actually going to drive the narrative around inflation, around tariffs, around the consumer, how things are doing in real time for all of these different topics. It's Amazon and Apple. These are the big dogs of this earnings season. The CNN Fear and Greed Index today is coming in at 36, unchanged from yesterday. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth is actually greed. So you're seeing the markets when they're going up, a lot of stocks are going up. Again, when they're going down, a lot of stocks are going down. So there's a lot of correlation out there, which is a good sign, right? You're not just seeing Mag 7 going up and then everything else is selling off. You're not just seeing staples going up and everything else is selling off. Everything's kind of moving in tandem, which tends to benefit the masses, right? Even being diversified, if you are diversified and there's positive breadth correlation, that tends to be a good thing for your portfolio. Now, put and call options coming in at fear, market volatility at neutral, safe haven demand in fear, and junk bond demand currently at neutral. We will get a new AI investor sentiment survey coming out on Thursday. There's still so many bears out there. Bears sitting at 55.6%, over double where the bulls are at 21.9%. Even neutral investors coming in at 22.5%. I mean, I've never seen neutral investors higher than bullish investors ever in my life. Okay. That just doesn't really happen. Like, I can't recall another time that has happened. And it's happened, okay? So there's a lot of room for people to turn more bullish here. And I think that's a testament to kind of where the markets are at, just generally speaking. There's a lot of room to turn bullish if we do get the right set of news and announcements, hopefully a pause on China tariffs. That is literally step one. It should have happened yesterday or the day before or the week before. It should have happened a long time ago, in my personal opinion. Nonetheless, percent of stocks trading above the 50-day moving average sitting at 34.5%, which is on the low side of where we have been over the past, 5 years or so. It's, low side of 2022 levels, during correction levels of 2023 and other corrections we had in 2024, or near corrections in 2024 at least. Once you get to like 55%, 50%, then you're in kind of a average level of the last 5 years. So there's still, call it, 20 points higher you could rise here before you're what I would call like neutral. Now, take a listen to what Gabriela Santos says about time running out for China. I think this is very important.
So we do get those job report numbers for April on Friday. We think nothing too dramatic happening, a little bit of a slowdown to about 130,000. There are a lot of unknowns around immigration as well as federal layoffs. But overall, it's still too early, we think, to tell the effect of some of these bigger policy changes we got in April. It seems more likely to us we'll have to wait until May, until June to see that data, to be able to really calibrate our expectations. Similar for earnings. So far, it's been quite a good earnings season, but companies are feeling a little bit frozen as to the real clear guidance that they're giving us. And as a result, we haven't seen research analysts take down their earnings expectations very much for the year, basically in line with average. So it's also going to take us a little bit longer to understand. Sorry?
You think that's a mistake? That the analysts have not taken down the numbers?
Well, we think everyone knows they're not the right numbers. 10% is what we came into the year. It's still generally.
Can I stop you? Isn't that a problem? If everybody knows that they don't have the right numbers, isn't somebody not doing what they're supposed to be doing?
No, I think you get these during these big moments of uncertainty, during COVID, or even during the first trade war.
Okay.
It took us some time to actually understand how much revenues would be hit, margins, and then the bottom line. So what happens in the interim? The multiple does the heavy lifting. So you get that multiple contraction, and then
the market's already doing the work.
Exactly. And, you know, it depends exactly how much. But I think that's part of the reason why it seems unlikely that we unwind more than this half that we've already unwound of the biggest sell-off, exactly because we've yet to actually see the impact on earnings and on the economy. We all know the direction is softer. It's just a bit tough to actually calibrate that. And so the next 100 days are going to be really, really important to understand the base case for tariffs, the offsets from fiscal, the response from the monetary side, and what's going on with AI.
What is your sense? Look, there's a whole bunch of hedge fund guys and analysts that have paid enormous amounts of money to satellite providers to look at shipping coming from China, ships that apparently have nothing on them, ships that never went, all of this. And there's this view, I don't know if it's become the consensus view, that somehow we're going to get to the end of May and all of a sudden you're going to walk into all of these stores and they're just not going to have the merchandise you want. And all of a sudden, not only are they not going to have the merchandise, the replacement merchandise is going to cost more. Is that your expectation?
I think time is running out to see a lessening of the tariffs on China. And I think it's a little bit like it was in COVID in the sense that we're all looking and earning for some high frequency data to get that understanding ahead of the numbers, knowing that there's a lag. And I think it caught a lot of attention, and it should, over the weekend, that we saw a 40% peak to trough drop in shipping from China to the U.S. because the tariffs are simply prohibitive, as Secretary Scott Bessent, Treasury Secretary, mentioned last week. Everyone knows these 157% headline tariffs are unsustainable. But we really need to see them actually come down pretty quickly before we're not talking about higher prices and companies figuring out ways to pass that on. We're talking about actual disruption to the supply chain. And especially remember, China has a pretty big control over a pretty important part of a lot of what we import from it. It's not easy to substitute overnight.
What is the wisdom inside of the House of Morgan, if you will, when it comes to the way Trump will ultimately deal with tariffs? Meaning some people believe that there really is a put and that he's just going to effectively not do all of these tariffs because he's going to realize that the market and the bond market and everybody else doesn't like it. And then if you read the Atlantic magazine yesterday, he says, I've had these views for 30 to 40 years and I'm going to do it. And this is what I'm doing. And if you don't understand that, you don't know what's going on.
Yeah. And I think it's all about the magnitude of the tariff. So it seems like we've gotten about 3 moderations in the overall headline level of tariffs overnight. News of an upcoming one on auto part imports. So that's taken down the headline tariff rate from the worst case, the highest since the 1900s, to the current, the highest since the 1940s. So I think there have been some moderation. We've taken some of the worst case off the table. That's good news. The market has recovered half of what it had sold off. However, our base case for the actual tariff rate we get was our worst case coming into the year, meaning still a pretty high tariff rate that remains, those 10% universal tariffs, as well as a halving of the China tariffs, which are unsustainable, but that still leaves us at about 60%. So that's why I think there's low conviction on the actual forecast for the economy and earnings. That doesn't mean there's nothing to do. So what we've been seeing our clients do is focus a lot more on rebuilding a core allocation. So much
what's in the core allocation, and does the Mag 7 have anything to do with it? And
this is really interesting because I think we're all coming into this big change in policy coming after a pretty exceptional 2 years, right? For equity performance, specifically growth in the US, specifically the Mag 7. So that was always going to normalize somewhat. We just got a catalyst from policy and from DeepSeek Monday. So what it means is a lot of our clients are thinking about more neutral allocation, equities, bonds. They're thinking about 50-50 value growth. They're really thinking about that international piece again. And within the bond side, it's rebuilding core fixed income because things had gotten either too cash-like or reaching for yield in things like private credit, leverage loans. So rebuilding the core for now before we get a bit more conviction one way or the other.
Now here on the day today, the Dow is up 0.41%, S&P down 0.01%, NASDAQ down 0.14%, Russell 2000 down 0.25%, but actually the VIX is down about 0.5% to 25.04, which is one of the lowest levels the VIX has been at in quite a while, which again is a good sign. The VIX selling off as the NASDAQ is down, as the Russell is down, as your other indexes are not really doing much today is a good sign heading into a big speech from Trump and, later on tonight. Okay? Take it for what you will. But nonetheless, we are sitting at the 300-day moving average, about 50 cents off of that currently on the S&P. If you get above $552 on the SPY, you're going to be looking at a larger breakout. And I think it's all going to hinge on what Trump says today in after hours with this speech. So we'll see. Let me know your thoughts on all of this information down below in the comments section. Have a fantastic rest of your day, and I will see you in the next one.